Get more insight on what seems to be a disconnect between Wall Street and Silicon Valley. Bob Rice runs Tangent Capital Partners, and he joins us now from New York. Bob, how was your tech portfolio today? Were you buying? Were you selling? What was going on?
We're trying to stay calm, and I think a lot of people that I know are trying to stay calm. Frankly, one of the technology angles here on today's action that hasn't been talked about a lot has been the role of high-frequency trading, technology itself, frankly, in driving these markets. The cyborgs are sort of taking over here, and the people are stepping back, and all the algorithms are pointing the same way, and it sort of becomes a self-fulfilling prophecy in terms of how these things are working. I think that's a large reason that you're seeing so much volatility over the last 2 weeks.
Bob, that may be true, but Cory Johnson just pointed out there are companies that are coming out with some pretty dismal outlooks in the world of technology right now.
Sure, absolutely there are. But I mean, you're talking about a 5% move in a single day, and you know, 5% moves in 4 days in the last 2 weeks. It's there's really nothing that justifies that kind of volatility in the fundamentals. I mean, I agree that the outlook has diminished a little bit for some of these companies, but I don't think it's nearly as dramatic as the market is indicating.
No, Bob, we just had Ari Levy talking about the good old days of 10 years ago, the bad old days from 10 years ago, and the tech blow up. When you start to see companies like JDS Uniphase, you know, a great symbol of the last bubble, report of disappointing guidance and the stocks take a hit, do you think that the shadow of that experience of the optical market, the networking market, just the enterprise hardware market completely disappearing, is that memory driving the market still today?
Well, I think that memory should be driving the market in one sense, Cory, which is, you know better than anybody else, that the phases are coming quicker and quicker. The changes are coming faster and faster. And so what is new technology one day can become old technology fairly quickly. And some of the changes that are going on are very, very profound. They're not changes that a management team can do really very much about. It's a little bit like looking at what happened with the New York Times going, you know, the digital world is happening. No matter what kind of changes you make, paper newspapers are in trouble. So, you know, you're seeing this happening at a much, much faster, quicker pace. And it does impact even some of the great companies that we have today, like Google. I mean, to me, the challenge that Google faces is, as we transition to mobile, I think people are going to be using their computers in a fundamentally different way. And that's going to really challenge the way that Google is making money right now.
This is Bloomberg West. I'm John Erlichman. Well, we want to talk more about Hewlett-Packard, of course, the company making a big purchase today, the world's largest computer maker buying Britain's Autonomy for roughly $10 billion. A lot of U.S. investors might not know a lot about this company, so let's go out to the newsroom again and check in with Cory Johnson for our drill down on this company people don't know a lot about, Cory.
Well, and yet it is something of a good-sized software company doing about $1 billion in revenue, so the takeout is about 10 times trailing revenues. Now, what's interesting about this company is the business has grown for Autonomy. It's a London-based company with most of its business in the U.S. The stock has suffered. It's down, I think, about 2% for the year. It's down about 11% in the last year. Now, the focus of this business is on something called unstructured data. What is unstructured data? It's a lot of junk. It's instant messages, emails, audio, video. It's all the garbage that's stuffing servers at corporate enterprises where there's lots of information that's hard to find. So these guys, at their heart, are a storage software and search business. Their goal is to be the 900-pound gorilla of enterprise search. Now, what we've seen from this company, however, is they will, this ironically named Autonomy, they will see no more autonomy as they go forward under the arms of Hewlett-Packard. Now, their revenues have been growing nicely. Here's the percentage of revenue growth year over year. Now, if you look back Q1 2010, you see that big number of 50%. What that shows you is how Autonomy has grown. And I think this is very interesting from the standpoint of Hewlett-Packard taking over a software company. What it's really taking over is a roll-up of software companies. Now, these guys know something about mergers because they've done so many mergers and acquisitions. They acquired Interwoven back in 2009 for $610 million. They acquired the digital division of Iron Mountain for $380 million right back in March. So these guys have been piling into the markets, buying their own businesses. Now they're getting 10 times sales on some businesses they paid much less than that for when they were doing these acquisitions. So Hewlett-Packard, when they take this over, and the deal has been agreed to by both sides, if that deal gets complete, they're going to be buying a company that is still being formed over there in London. So the most important thing I'll say about it is that while Hewlett-Packard's looking at about 12% operating margins of its old business, Autonomy has about 35% operating margins. So they're clearly going for profit. profits and paying 10 times sales to do that. John?
All right, thanks a lot, Cory. I want to bring Bob Rice back into the conversation from Tangent Capital Partners. Bob, HP, a company that has been a loser investment, so people have been piling into private investments like Facebook. Is it that they are making these investments because they just feel like they have nowhere else to put their money right now?
Well, I do actually think that's a part of it. I think that they are looking for something that's going to take them into the future. Everybody understands that the world is changing in a very kind of scary and profound way, and I think that they've gone a little bit too far in many of these cases in trying to latch on to what tomorrow's trends are going to be. You see the valuations in shares post and second market for companies like Facebook. And to me, I mean, you have to shake your head a little bit. And I bet you that a lot of the people who have purchased those shares in anticipation of a giant IPO are shaking their heads even harder tonight than I am.
But some IPOs not happening is one thing. I mean, if Facebook wants to go public tomorrow, they're still going to get the deal done at a big premium, no?
Of course they're going to get the deal done, but they're certainly not going to get, I don't think, the kind of valuation that just a couple of months ago people were anticipating maybe a $100 billion IPO there. And a lot of people were transacting on these secondary market exchanges assuming that was going to be true, and so we're purchasing shares with implied values of $65, $70, $80 billion. Those people are going to be probably pretty disappointed, I think.
Bob, Hewlett-Packard, a company that has so much trouble right now, and yet it can go out and spend $10 billion to buy a software company. Google goes out at the beginning of the week and buys Motorola for $12.5 billion. Now, there's probably an argument from some VCs that they can go out and buy something, or big companies can spend a lot of cash, and that's one of the reasons why they invest in some of the smaller companies.
Absolutely, and that has become, I think, it was, and I think it will be again, the primary exit vehicle for a lot of these companies. When you're looking at the balance sheets that these large companies have right now, you know, the big joke a couple of weeks ago was many of them had more cash on hand than the U.S. government did. So that's clearly a great place to go look for an exit, and a lot of people are building their companies explicitly with that in mind, and frankly not looking at doing the IPO route at all. And I personally believe that's a very smart way to build your young company at this point.
All right, Bob, thanks for the insight. Always appreciate it. Bob Rice, managing partner at Tangent Capital, joining us from New York.